Welcome to the Alchemy of Achievement. My name is Eric Brown, and I'm a portfolio manager with CG Wealth and a member of Graham Wealth Partners. Today, we're going to be talking about something interesting that maybe some people know about, but some people don't. But I just want to set the stage. Let's say you are a business owner and you know at some point in the future there's going to be a taxable event for selling your business, possibly when you exit it, when you retire, when you move on, and you want to make sure that you know what that number is first, of course, but when you know that number, then what you also need to figure out is, will you have to sell things? And will you have to sell things that you don't want to? As an example, if you were to pass away before your expected time, in your 90s or something like that, if you were to pass away suddenly and your business had to be sold, what would happen? And would there be a tax liability there that required you to sell things that you didn't want to? Maybe one of your businesses, if you own multiple businesses, maybe the primary business, maybe real estate, maybe the vacation home that's been in your family for generations. And when you think of those things, what we want to try to solve for is, how do we make sure that we don't have to sell those things, even if we were to die tomorrow, or if we were to die in 10 years, or if we were to die in our 90s? We need to figure out what that number is and how to deal with it. So one thing that people do is, when they look at these type of things, is they can estimate what the future tax liability is. And that's something that you could do with your accountant. That's something that you can do with our team of professional financial planners. We can figure out an approximation of what that might be. And of course, it's approximation because no one knows what the future holds, but at least it gives you a general idea of what that number might be now. And different solutions offer different ways to deal with that problem. That you don't want to force sell anything. You want to make sure that the value of your estate is the largest, either to go to your family or go to charity or wherever it is you want your money to go to. I'm sure you don't want it to go to the government, to CRA. You want as little as possible to go there and the most possible to go elsewhere. So one thing that people use is a strategy called permanent insurance. And most of you have probably heard of that or have an understanding of that. But today, what I really want to focus on is the difference between putting money inside a permanent insurance policy and keeping it out inside your corporation, essentially, and really looking at what the advantages to you would be. So permanent insurance, I'll just give you a general idea of what it is. We can get into the nitty-gritty details maybe in another video at another time, but it is insurance that will last until you die. And to separate that from term insurance, which lasts for a term, 10 or 20 or 30 years, permanent insurance will last until you die. And that also means it's more expensive because the insurance company knows that they will have to pay you out, where term insurance, they might not have to pay you out if you outlive the term. So the reason why having permanent insurance is important is because you want it to last until you die. And that's very important. So another thing that we need to consider is the taxation of permanent insurance. And there are tax advantages. So cash that grows inside of a permanent insurance policy grow tax-free. If you were to die, the money is paid to your beneficiaries tax-free if it's in a personal account. And there's different tax considerations if you own it within your corporation, which often makes sense, but we don't need to get into the nitty-gritty details of that now. Really, what I wanted to do today was just give you an example to get you thinking about it, to say, am I going to be able to deal with the taxes that are inevitable, that will come with when I die, the selling of the business, the other assets that I have? Will I be able to deal with that? So let's just use an example so it solidifies in your mind. Let's say we have someone who's 67 years old, 66 years old, they don't smoke, they're in generally decent health, and they have a big tax liability that they want to deal with. And they want to make sure that the most amount of money goes to their beneficiaries. Let's say they have a successful business, multiple successful businesses, and they're going to do it within their corporation. So what we're going to do is just compare putting money into this type of policy for 10 years and compare it to if you had actually just put it in your corporation that was getting you 5%. For this example, I'm going to use $260,000 that you're putting in for 10 years. So essentially it will come out to $2.6 million that you're putting into an insurance policy, and then it's going to be $2.6 million that will be going into an investment as well. So if you look out in 10 years, the value that will be coming out, the net estate value that will be available to you, there's a significant difference already, and it actually gets bigger as time goes by for several reasons. Like I mentioned before, the tax-free growth inside a corporate insurance policy and the tax advantage treatment of the income as it comes out of the corporation. So if we look after 10 years for the permanent insurance policy, in this case it's a whole life, you're coming in at $4.8 million as the net estate value. So that will be the value that's paid to your estate that you can use to pay taxes, that you can use to give to your beneficiaries. And in comparison to that, on your investment, if you invested that same amount of money over 10 years, you're going to be getting just over $2.1 million. So there's a significant difference there. So over time, if you look out in the 20th year, the net estate value on the insurance will be for almost $5 million, 4.997. And the value on the investment will be $3 million, just over $3 million. So you can see there's a considerable difference. And if that's something that you're worried about, you have a big tax bill to pay, if you're worried about whether or not you have to sell assets or that family home or that family lake property that's been in your family for generations, you need to make sure that you're doing something about it and not just having to pay a whole pile of taxes to CRA. If this is something that you want to talk about, feel free to book a meeting with me. We can have a discussion about your individual circumstances to see if this type of strategy is right for you.